So in terms of our role, ultimately we're trying to define portfolios that our end clients or our clients of our financial planners can actually use, can actually implement in the real world. So we're looking for groups of companies, when you combine them together, bring attributes that suit an investment portfolio in equities. So issues such as risk, diversity, a spread of choices through different sectors are important, as well as the actual investment returns that we're seeking from each stock, that when collectively combined together to generate some good returns from the portfolio and has a degree of robustness through the economic cycle, shall we say, but also year to year, so we're not getting sort of too much variability from sort of time period to time period as it would be. That way, ideally, investors are sort of comfortable with what they're investing in, they can sleep at night, that sort of test, as well as delivering the returns that they require from their investment needs. FY17 was an interesting year in the sense that, as the cliche says, it was sort of a year of two halves. I would say a year ago the banking sector and the resource sector were quite at low levels, and so they've rebounded quite strongly over the course of the FY17 year. So resources and banks did quite well in terms of their sector performance. However, they were coming from low bases and they were quite poor performance a year prior. So it's sort of a little bit of sort of opportunistic timing, shall we say. We don't expect those good results to continue into FY18. Other sectors such as healthcare, non-bank financial services did quite well. Utilities did quite well with the rise in electricity prices, shall we say. Some other sort of sectors, telcos, were quite weak in FY17, just with the various challenges they're facing and increased competition, such like consumer staples and discretion was mixed bag. Obviously we're seeing the effects of increased competition from overseas, the Amazon effect, that sort of stuff that's impacting on those stocks. And REITs, after being strong performers in the first half, were quite soft in the second half, again sort of behaving in the inverse manner to how bond rates move. So they were quite soft in the second half of the year, and generally soft overall for the full year. Going forward, FY18, we're not seeing a lot of growth across the market, but it is composed, as we know, with the Australian market, we're 50% banks and resources, so we've got a very lumpy sort of makeup to our market. Both those sectors we see as having muted growth in FY18, so not a lot of sort of good news from there to drive the market up. We're reliant on the other 50% of the market, shall we say, to get growth, and overall we're seeing EPS growth the order of about 4 or 5%, that's all at the moment. From the non-bank, non-resource sector, about 8%. So chances are the good performing stocks for that window of a year will sort of come from that other 50% of the year and not from the banks or not from the resource sector, we suspect. So it's going to be a tricky market. It's going to have to be one where investors are patient, maybe doing a little bit of sort of opportunistic buying on any pullbacks, that sort of thing. We can't just rely on a strong bull market alone to generate the returns. And as I said earlier, the work we're doing on identifying those companies with really strong IRRs and ROEs, such like, hopefully we'll identify opportunities, and if on average they'll perform reasonably well as well in that time period. In terms of the structure, we have taken a fairly cautious sort of defensive style of view for a while now, and that sort of ties in with Lonsec's view to be underweight Australian equities. So we're not just an island unto ourselves. We sort of got to be compatible with what the overall Lonsec view is on different asset classes, of course. But within that sort of defensive approach, we're still trying to find stocks that can grow, because that's, at the end of the day, that's what an equities portfolio is supposed to do. Sectors like healthcare, financial services, ex-banks, some information technology sectors, although it's not a big component of the Australian market, but they're sort of areas that are showing good growth, have some good quality companies to choose from, fairly defensive in nature, so that if we did have an economic slowdown, they're not as affected. They're sort of essential services type of businesses in many respects. So we've tended to sort of go for, overweight positions in those sectors. But in addition to that, there's always some companies in other sectors that are just good quality companies and are well positioned in their segments that they can grow through a variety of economic settings. So we're happy to sort of follow those more from a bottom-up sort of process, shall we say. But they're still worthy of sort of including in portfolios when we believe they can sort of have that sort of those growth phases. Some of those can be more cyclical companies, or others they're just new companies. They're taking market share off incumbents, that sort of stuff. They're just doing things better, or using more technology and doing things cheaper and that sort of stuff. So always happy to sort of look at those sort of opportunities. There's a few sectors that we're sort of a little bit wary of at the moment. On the flip side, banking is one where, with the housing market possibly peaking, we're just wary of sort of lending growth and also the risk that impairments might start to rise if we see a slowdown or even a retraction in house prices. Resources are another area we're also a little bit cautious on because of the commentary about China earlier, where commodity prices are a little bit sort of subdued. They're not rock bottom, but they're not as high as where they were a few years ago. And we're just questioning the surety of growth, shall we say, in those stocks. Of course, those companies are always price takers. They don't control the commodity price themselves. They don't control the exchange rate. So a lot of their profitability year to year is in the lap of the gods, shall we say. It's beyond their own control. So we're a little bit cautious of those sorts of stocks at the moment as well.